Welcome to another module of Financial Management. Unit 6 of Financial Management, which talks about leverage. Friends, today's module will help you to understand the various objectives of leverage, and there are certain operating leverage, financial leverage. Here we will discuss what is operating leverage, how it is calculated, what is financial leverage and how it is calculated, and at last we will use different formulas. We will understand what are the formulas to calculate these leverages. Before proceeding further, friends, I would like to ask you, what is the meaning of leverage? In a simplified terms, in a non-financial term, if I have to say leverage, leverage is nothing but is the influence of power to achieve something. I am using influencing somebody or with the help of something to get something. That is a powerful source which I am using it for my benefit. To get the return what I am expecting with the help of some powerful source is called as leveraging. Suppose if I am applying for a job and I know this job I will get it easily if I know somebody who is associated with this department's ministry. Assume I am applying for a job of railway and I know somebody into railway ministry or the railway minister. So I am influencing or I am leveraging his or her name, the Minister of Railways name, to get my job done, to get my offer letter in this railway department. So that is what is the meaning of leverage. Means using the name of a person or using something to get the expected return from the particular thing. That is what is the meaning of leverage, is the influence of power to achieve something. So in financial terms, if I have to say in finance, what should be the leverage? In finance, you use your money or some investment to leverage to get other returns as per your expectation. So if I have to define in a technical word or a financial terms, you can see on this slide, it means in finance, capital structure refers to the way a corporation finances its assets through some combination of equity, debts or hybrid security. A firm capital structure is then the composition or structure of its liability. When I say equity, you know, when we say debt, you must have studied in module 5 about equity and debt. You must have also heard hybrid in earlier sessions of financial management. But let me reiterate you, hybrid securities is a very high security, very sensitive market, which is have a very high market volatility, which has very high market changes. Those are hybrid securities. The firm's capital structure is then the composition or structure of its liability. What is liability? Liability is something which today or tomorrow I have to pay somebody. Anything which is on my head as a tension, that is a liability. Alright? Let's move further, friends. Leverage. In the term leverage, it is used differently in a different structure. In investment term, leverage is denoted a different way. In a corporate finance, leverage is known as a different way. When I say leverage, leverage can be further divided into three parts: operating leverage, financial leverage and combined leverage. However, you need to understand, friend, leverage primarily into two parts. One is into the investment side, the other is a corporate finance. There are two different fields. Investment is something which I am investing directly in the market. Corporate finance is something where I am getting money for my project to be completed. I am sourcing these funds from the industry. Investment, you know, you are directly investing into market. When I say corporate finance, It is nothing but a company. Corporate is nothing an organization, a multi-diversified corporate or organization. If I have to get a corporate finance, what are the different sources of finance? Yes, one thing which is very common is the banks. The bank will finance you, bank will give you a loan. This is a very common terms for finance. However, there is other source of finance also. What are the other source of finance? Borrowing from the market. How do you borrow? As a corporate, how will you borrow from the market? Can you directly go and ask for the money in the market? No. There is a different source of asking money. This source, one of the best sources, coming out with a public offer, right? Public issue or equity shares. What is the plus point compared to bank finance and the equity market? When corporate firm is financed by the bank, corporate has to give the rate of return as per the interest rate pre-decided at the time of getting it financed through the bank. So corporate, whether it makes profit or loss, you need to give return that amount to the bank. However, in the primary market, market that is security market, where I am referring to a stock exchange, here you borrow money from people, you borrow money from public, use it for the expansion of your company and the better production of the company in order to get maximum return, so that it can be given back to the investors whose money you have taken it or borrowed it for the use. However, here as a corporate, you don't have to return it as per the fixed rate of interest. Here public, the funds you borrowed from the public are the equity holder or stakeholders in your organization, where they are entitled to get the profit in your firm. However, when we are financing, the investment is done by the bank. If you are financing through the bank, you have to give the particular rate of return as per decided. Here in public fund, public borrow from the public is the people who have got the stakeholder, they are the owners of your company. They are the stakeholders. They have an equal right to participate in the profit and also in the losses. Whereas if you finance from the bank is not responsible to bear the loss. Bank is only responsible to get the return what they have paid for that. And so on, the corporate and the investment has a different multiple definitions available in the field. Every person has its own way of defining the leverages. Right? We'll move further. Now, the first part when I am talking about the investment part. When I am talking about the investment, we will first understand the leverages in the use of investment part, and then we will go to the corporate finance. Now, investment, the investment are used for the leverages in three ways. One is accounting leverage, second is notional leverage, third is economic leverage. The first, accounting leverage, is something related to account. When I say accounting, what comes to your mind? Assets and liabilities, right? So accounting leverage is the total assets divided by the asset minus total liability. When I said accounting leverage, if I have to see what is the ratio of the accounting leverage, well, how can you calculate? All I need to do is, the accounting leverage is total assets. I have to divide the total assets and minus the liability. Always remember, asset has to be higher side, liability has to be lower. So if you minus liability from the assets, the buffer what you remain is your assets, is your profit. Whereas if asset is lower and liability is higher, it is into minus, deficit, the loss of the company. So accounting leverage is refers by the total assets minus total liability. Now coming to the notional leverage. Notional leverage is nothing but the total notional amount of assets, notional amount which is Notional, it is not visible, but it is in the market. Goodwill, it's a notional value. Credit rating, notional value. Goods in transit, notional value. So national notional leverage is total notional amount of asset plus total notional amount of liability and divided by the equity. I'll repeat, notional average is total notional amount of assets, whatever we have. You have to add the total notional amount of liability. That means notional amount of liability is something, expected liabilities, expected commissions to be paid, expected outstanding which you need to be clear. Okay, those are notional liabilities. So notional leverage is total notional amount of assets plus total notional amount of liability divided by the equity. Equity means shares. So you get the amount, that is notional leverage. Now economic leverage now. Economic leverage is volatility of equity divided by volatility of unlevered investment in the same assets. Now, sounds to be a little confusing, right? Here it says volatility of equity, that is the up down of your equity market, the returns what you expect, volatility what you have, divided by the volatility of unlevered investment in the same assets. Means unlevered investment, when I am talking about, it refers to the investment which are not the actual book value which is written. It is unlevered. It is not through the standardized process. It is something hypothetical value what you are clearing it out. So those are unlevered investment in the same assets what we are talking about earlier. So investment is considered from the three angles, that is accounting leverage, then we talk about notional leverage, then we talk about economic leverage. Right? We'll move further. Now we'll go to corporate finance. Friends, corporate finance is little tricky to understand. Investment is direct investment. Corporate finance, there are three methods of doing leverages, calculating leverages. First leverage, when I am talking from a corporate finance side, it's a degree of operating leverage. That is also known as DOL. Degree of operating leverage. What percentage, at what degree of your leverage are you operating into? That is called as degree of operating leverage, and the formula is EBIT plus fixed asset. When I say EBIT, it is nothing but earning before interest and taxes. That is pre-taxes, before paying taxes, whatever is my earning. Okay? My earning on my assets are 10 crores, but I have to pay tax on that, but I haven't paid. So this is nothing but a gross amount expected before interest and the taxes. You haven't paid your interest on your outstanding, on your loans, and you haven't paid any taxes to government. So both the things before paying any taxes and the returns or the investment, that is interest you have paid, what do you get? Plus your fixed cost. What are fixed cost? Fixed cost is rent, which is fixed. Salaries, fixed. Your motor vehicle expenses, fixed cost. Maintenance, that is a fixed cost. Fixed cost is nothing but which is fixed, can be every month or every year you have to pay that. That's a fixed cost. So expected earning, whatever you have earned before the interest and tax, your earnings what you have earned before paying any taxes and the interest, divided by EBIT, that is earning before interest or taxes, will help me in calculating degree of my operating leverage, right? So DOL is calculated as EBIT plus fixed cost upon or divided by expected earnings before interest and tax. Another level of calculation of corporate finance is degree of financial leverage. One was degree of operating leverage, the other is degree of financial leverages. That is DFL. The second method what we are discussing now is financial leverage. Earlier was operating leverage. Again, the formula is something similar to earlier one. That is earning before interest and tax divided by earning before interest and tax minus total interest expenses, that is all the expenses from EBIT, earning, what is your earning, gross earning minus interest on expenses, whatever expenses you are doing, okay, on the interest, that you have to minus from this. So EBIT upon EBIT minus total interest expenses will give me degree of financial leverage. And the third level we are talking about degree of combined leverage. When I am talking about combined leverage, that means degree of operating leverage and degree of financial leverage. So if I have to calculate the degree of combined leverage, what I need to do is degree of operating leverage into degree of financial leverage. This will give me degree of combined leverage. So when I have to say what is DCL, DCL is nothing but DOL into DFL. So degree of combined leverage is nothing but degree of operating leverage into degree of financial leverage. Remember friends, in corporate finance these three terms play a very important role. The first term, that is degree of operating leverage, second term degree of financial leverage, and the third term, that is degree of combined leverage. So when I have to calculate the leverage, I need to be concerned for both the things. Alright? Any questions? Let's move further. Operating leverage and financial leverage. Now actual formula, how it will be. You have seen earlier in corporate finance DOL, DFL, DCL. Friends, remember this term DOL, DFL and DCL. Right? Prime is this. Combined leverage you need to remember, because in next slide we will use this term DOL and DFL. Now let's see operating leverage. What we have seen here, operating leverage. What we have seen, the formula was earning before interest and taxes plus fixed cost upon earning before interest and taxes. Now let's see further how do I calculate actually. The formula is revenue minus variable cost. What is revenue? Revenue is nothing but EBIT. It's a profit or it's a money, income. Revenue minus variable cost. What do you mean by variable cost? Variable cost is the cost which changes from time to time. Can be rent. Rent is not a variable cost, it's a fixed cost. So if I have to say variable, then electricity, variable cost, wages, variable cost. So all the revenue profit what I made minus all the variable cost I need to take out. Upon revenue minus variable cost minus fixed cost. In first stage here what we did, revenue minus only variable cost. You get any particular amount over here, X amount. So here X minus Y amount it is. That is out of revenue and variable cost you minus your fixed cost also. So when I say revenue minus variable cost, I have got my money, profit, not profit, gross profit, net profit, it is a gross profit. If this is my gross profit, if I minus my cost is my expenses, and there are two types of expenses, fixed expenses, variable expenses. So both the expenses if I take out, can I say it is an income? It is an income. So if I say total money, that is profit minus income, profit minus all the expenses, what will I get? Income. So can I say this becomes my operating income over here? Okay, so revenue minus variable cost, that remains same here. Final calculation would be revenue minus variable cost minus fixed cost. If I minus this variable cost and fixed cost from my revenue, I will get my operating income. So actual formula for operating leverage is revenues minus variable cost upon operating income. That would be my operating leverage. We'll move further to understand financial leverage. Financial leverage is usually defined as operating income. Operating income is what I require to operate my company, my organization. So operating income minus net income. When I say net income is after tax, after interest paid. My profit after the tax is called as net income. So operating, that is operating cost, I need to take operating income. Here I am talking about financial leverage, that means final income. So here I have to take net income. So financial average is usually defined as operating income upon or divided by net income. Whereas in operating cost, revenue minus variable cost upon operating income. Move further. Operating leverages is an attempt to estimate the percentage change in operating income, that is earning before interest and tax for 1% change in revenue, as we discussed earlier. And financial leverage tries to estimate the percentage change in the net income for a 1% change in the operating income. Operating is nothing but an attempt to see the or notice to calculate 1% change in revenue, right? And financial leverage talks about the income. That's difference. Here we are talking about in operating leverage, we are talking about operating, that is revenue, that is expenses. Here we are talking about financial leverage, we are talking about the income. So now the product of these two is called total leverage. Operating leverage, financial leverage. The total, if you do operating leverage plus financial leverage, you will get the total leverage and estimates the percentage change in net income from 1% change in revenue. So we discussed earlier. In under the corporate finance, we went first to understand the operating leverage degree. Then we talk about the financial leverage. Then we talk about the both combined leverage. So it is DOL, DFL, right? Same way, if you see it, if I put in the formula, earning before interest plus fixed asset upon earning before interest and taxes. Here also it seems earning is nothing but a revenue minus variable cost. What are variable cost? That is all your expenses, right? And then finally, that is revenue minus variable cost upon operating income, what I receive. And financial average, what we discuss, is nothing but a total interest expenses. Expenses we need to pay so that you remain with a profit. So here I am talking about operating income upon net income. That gives me total financial leverage. Financial leverage. Now if I have to calculate the total leverages, so I need to club it out both together. Operating leverage, financial leverage. These two both together is called as total leverage. Any questions, friend, before we move further? Let me recap you once again. In finance, capital structure refers to the way of corporation finance assets through some combination of equity, debt or hybrid securities. A firm capital structure is then composition or structure of its liability. And what is leverage? Leverage is the influence of power to achieve something. Leverage further is divided into three types: operating leverage, financial leverage and combined leverage, what we discussed. That is operating cost now. Okay. Leverages, we discuss investment and the corporate finance, two different things. When I talk about the investment, it is into three terms: accounting leverage, notional leverage and economic leverage. When you talk about the corporate finance, it has the three layers, that is degree of operating leverage, DOL. We have DFL, degree of financial leverage, and we have the third, that is combined degree of leverage, that is DCL, and the formula is DOL into DFL. Same thing we discussed over here, that is revenue minus, if I have to calculate operations leverage, it comes out to revenue minus variable cost upon revenue minus variable cost minus fixed assets. So if I take out variable cost and the fixed cost from revenue, what I will get is operating income. So actually formula is revenue minus variable cost upon operating income. That will give me operation leverage. And if I go to next, financial leverage, it is nothing but operating income what you have minus net income. Any questions? Same thing we have discussed in a theoretical form here. We'll go further to summarize the earnings for today. Can I ask you, what do you understand by hedge fund? What do you understand by hedge fund?